Hi, let's take a look at question 3 now. And as you know, that's a capital gains tax question. And once again, we go to the required and see what the required states. Calculate the taxpayer's taxable capital gain or loss. That's important. What is that telling you? It's telling you that we're looking for 33.33% of the taxpayer's total capital gain to be included in his taxable income, right? Capital gains tax question, we see there's something about a primary residence, and you could separate your calculation between the house and the land. We don't know what that's about, but we know that we've got to include 33.33% of the total capital gain in taxable income. So it's a pure capital gains tax question. Let's go to the beginning now and start right at the beginning and see what the situation is. And there's a taxpayer. Let me get my highlighter out again. He retired in January 2014 at the age of 60. That might be important. He's married to Tandi in community of property. And we know for capital gains tax purposes, being married in community of property affects the calculation. And they decide to purchase a game farm. They move to the game farm, and they've disposed of some assets. So essentially, there's a primary residence. What else is there? There's a small business. There's a microlight aircraft, and there's some listed shares. So there are 4 assets that they dispose of during the year of assessment, and we need to work out the capital gain on each. We deal with each one separately, work out the proceeds, the base cost, and the capital gain for each, and then add them up to get to the aggregate capital gain. And what is the first one? Let's get right into it, the primary residence. Okay, let me just write that out. Now, this was a previous exam question, and students did really poorly in this question. And why did they do poorly? It was because of this primary residence disposal. This is the area where they did very badly. So let's work through it and just try and understand some of the underlying principles involved. Quickly, just briefly read through it. He owned a small holding, in other words, quite a large piece of land, which he sold in January 2014. He inherited it in November 1993. Why is that important? You always need to know when the asset was acquired for capital gains tax purposes. When was capital gains tax introduced? On 1st of October 2001. So this is acquired before capital gains tax came into being. So that's important. It's going to affect the calculation. And he's been using it as a primary residence. In other words, it's his home ever since. He inherited it. And the value of the property when he inherited it was $200,000 for the house, $1.8 million for the land. The land comprises, and this is going to be very important, 4 hectares. Now you'll actually see this $200,000 and $1.8 million is not really relevant for your purposes. I'll tell you why later. You can really ignore it. So it was acquired before 1 October 2001, and the size of the land was 4 hectares. Right, now what are some of the issues here? We know that if an asset is acquired before 1 October 2001, we need to get a value for the asset on the day the capital gains tax was introduced, 1st of October 2001. It's called the valuation date value. And we're going to need a valuation date value for the primary residence. And this primary residence was sold for a profit. So in that case, how do we go about establishing the valuation date value? There are 3 options. Market value, which you're always going to be given in an exam. You have to be given it. Time apportionment base cost, which you don't need to work out. You're going to be given it in an exam. And that's why those early amounts, the values pre 1 October 2001, 200,000 and 1.8 million, You'd only need them if you needed to calculate the TAB, the time apportionment base cost. But you'll be given the TAB, so those amounts are irrelevant for your purposes. You're given the TAB. So when you're establishing the valuation date value, you need market value, which you're given, TAB, which you're given, and the third option is the 20% rule, and that you have to calculate, right? Once you've got those three, you choose the greater of the three, and that's your valuation date value. So that's what needed to be done here for this primary residence. So that's a starting point. What's the next step? What is also crucial for this question, and this is what many students missed out on, was that this property was situated on 4 hectares of land. Now, most students know you live in a house, it's your home, you sell it, it's got a little garden around it, there's a price, you're selling price, the proceeds less base cost, and there's a capital gain. And most students know that for a primary residence, the first 2 million of the gain is excluded for capital gains tax purposes. So most people, when they sell a home, there's no CGT consequences because most people don't make more than 2 million rand capital gain. But there are always exceptions to the rule in tax. And here is one of the exceptions. The exception for the 2 million rand exclusion is if your house, your primary residence, sits on a piece of land that is greater than 2 hectares in extent, the area beyond the first 2 hectares will not qualify for the 2 million rand exclusion. That you needed to know to answer this question. I've done a little graphic here just to make it more clearer to you. Here we have a house and it's sitting on a piece of land, and in our example, it's 4 hectares. This entire piece of land is 4 hectares. What does the primary resident exclusion rule state? Only the first 2 hectares, the gain on the first 2 hectares qualifies for the 2 million rand exclusion. The remaining area of the land, in this case it's 2 hectares because it's a 4 hectare piece of land, the gain on this portion of the land will not qualify for the 2 million rand exclusion, right? That you needed to know to answer this question. So when we go into the calculation, the first point is we've got to work out the gain on the house, just the house, and the gain on the entire 4 hectares. That's our starting point. So that's what we're going to do now. The gain on the house and the gain on the entire piece of land, entire 4 hectares. So let's start there now. So what is capital gain? It's proceeds less base cost. So we've got a primary residence, and what is the proceeds? Well, we're told that in the question here at the bottom, the plot was sold for 7,800,000 related to the house, and the remainder related to the land. So proceeds for the house is 800,000. The remaining part of the proceeds relates to the 4 hectares of land, 6.2 million. So there we've got proceeds, and let's just fill this in. In this column, remember, we're separating out the capital gain on the house and on the 4 hectares of land. So we've got proceeds, house, land. Now we want to work out the base cost of both of these. So what's the starting point? I've already said we need to work out the valuation date value. Why? Because this property was acquired before 1 October 2001. So it's a simple matter. You've just got to list each value, and you're told at the bottom of the question what the market value of the house was. Just list it. The house was 400,000 and the land was 3.5 million. So that's the one option that you could choose for the valuation date value. The second option would be the time apportionment base cost. Once again, you don't need to calculate it, you'll be given it. There it is at the bottom of the question. The house's TAB was 380,000. Once again, excuse my handwriting, but you do have the solution in front of you. And the TAB for the land was 3,420,000. So that's one option, the second option, and the final option is the 20% rule. This is the only one where you need to do a calculation. And what does the 20% rule say? You multiply the proceeds of the house, which is 800,000, we know that. But this is something you do need to know for calculating the 20% rule. You've got to deduct any expenditure incurred after 1 October 2001. So if we scan through the question here, we'll see that he had an office extension built on the house during 2002 at a cost of 300,000, and we scan through the rest of the question, no other expenses incurred after 1 October 2001. So, and obviously this expense relates to the house, not the land. So when you're working out the 20% rule, you take the proceeds less any expenditure incurred after 1 October, and you multiply it by 20%. And that gets you to an amount of 100,000. A value according to the 20% rule for the house. What about the 20% rule for the land? That's simpler. The proceeds for the land are 6.2 million. And there's no expenditure incurred after 1 October. You can just put a nil there, multiply by 20%, and that gets you to an amount of 1,240,000 rand. So now you've got the three options: market value, TAB, or 20% of the 20% rule. And you want to choose the greatest of these three. Obviously, market value gives you the greatest of the three. So that'll be your valuation date value, the value of both of these assets on 1st of October 2001. Remember, we're working towards calculating the base cost. So I'm just going to do an abbreviation, call it VDV, valuation date value. For the house in this column is 400,000. For the land, it's 3.5 million, right? But we want to work out what is the base cost of the house. Well, was there any expenditure incurred after 1 October 2001? Yes, we know that. There was an office built onto the house. So that's a legitimate improvement. It can be included in the base cost. There were no expenses on the land after 1 October 2001. So let me just draw a neat little block around here. There, the base cost. Here we have the base cost now. For the house, it's 700,000. For the land, it's 3.5 million. So we've got proceeds, less base costs, and that'll give us our capital gain on the house and our capital gain on the land, the entire extent of the land, 2.7 million. There's a capital gain. So this is our starting point. Capital gain on the house, capital gain on the land. Go back to our little graphic here. We've got a capital gain just on the house, and we've got a capital gain on the entire property. Right, so that's the first portion of the calculation sorted out. Now we know that, let me just start on a new sheet of paper. I'll just repeat it here. And now I'll call it primary residence and remaining land. and we want to work out what is the capital gain on the primary residence, including 2 hectares of land. And the remaining land, which in this example happens to be 2 hectares as well. So what is the capital gain on the primary residence, including 2 hectares of land? Well, it's relatively simple. We know that the capital gain on the land was 2.7 million, and we simply multiply it by 2 divided by 4 hectares. So in other words, half the capital gain relates, it's quite logical, half relates to the first 2 hectares and half relates to the second 2 hectares. Obviously, if this is a 3-hectare property, your apportionment would be different, or it is 10 hectares, you do a different apportionment. But in this example, it's 50-50. Right, so we've got capital gain, first 2 hectares of land for the primary residence. What is the capital gain for the house? We know from our earlier calculation that it was 100,000. Obviously, there's nothing for the remaining part. So we have a capital gain of 1,450,000 for the primary residence, including the first 2 hectares of land. And we've got a capital gain of 1.35 million for the remaining 2 hectares of land. Okay, now let's just stop there for a moment and let's just focus on the primary residence. We know that a primary residence qualifies for 2 million, the gain on the primary residence qualifies for a 2 million rand exclusion. And normally you'd simply deduct 1.45 million here and there'd be no tax payable. But of course there are always exceptions. And what is the exception in this question? What does the question state? If you go back to the information, he built an office and he used it for business purposes. That's important. So obviously he's been claiming business-related expenditure related to the office. And when was it completed? In 2004, 9 years ago. And 5% of the property was used for business purposes. Okay? So we go back to our calculation here, just on the house plus the first 2 hectares. We know that if you use your property for business purposes, the portion that relates to business, the capital gain on the property, that portion will not qualify for the primary residence exclusion, and it's going to be taxable. So how do we work this out? We simply multiply the capital gain, 1.45 million, by 5%, and in this case, in the 12 years since capital gains tax was introduced, 9 out of the 12 years, 5% of the property was used for business purposes. And if you work that out, that comes to 54,375. What does that mean? It means of the 1,450,000 rand capital gain on the primary residence, 54,375 rand relates to business, the business conducted, and unfortunately, that's going to be a taxable capital gain. So what happens? You put it in the right-hand column. There it is. It's gone into the taxable column. Okay. Why do we include it below here? Because you now want to see, well, what portion of the capital gain on the property will qualify for the 2 million rand exclusion. Only 1,395,625 rand will qualify for the exclusion. And obviously that's less than 2 million rand, so you can just put in here less primary residence exclusion. Obviously, you can't create a deduction here, a negative. You just deduct what the gain is, up to 2 million. His gain here is less than that. So the gain on the primary residence, including the first 2 hectares of land, is 0, apart from 54,375, which related to business usage. Okay? So that is the primary residence sorted out. Now, what about the remaining 2 hectares of land? That's very straightforward. It wasn't used for business purposes. That's going to be included as a capital gain. You just carry it down. There's no primary residence exclusion for the remaining 2 hectares of land. So that 1,350,000, there it is, that also gets carried into the right-hand column, and that is going to be part of the aggregate capital gain, and the 2 amounts combined amount to the capital gain on the primary residence. So there, that was the section of the question. Here we have it, primary residence. This was the section that gave students the most problems in the exam. There is an example in the textbook, which I also recommend that you work through, and you do have the solution as well, to make sure you understand the principles involved. So that is the primary residence sorted out. Let's move on to the next asset, a small business. Let me just write that in. We know that the taxpayers disposed of a small business, and what does the question say? He purchased it 7 years ago. So in other words, after capital gains tax was introduced, so there's no valuation date value to determine there. The business was very successful. He disposed of it during the current year of assessment, and the capital gain was correctly calculated at 3 million. In other words, the proceeds has already been worked out, base cost has been worked out, base cost has been deducted from proceeds to give you capital gain. So half the work has been done for you. You're given the capital gain, and it was 3 million. So let's just put that into the inner column, 3 million. Now you need to know, well, in fact, you don't even need to know going into the exam. If you look at the schedules at the back of your exam paper, you'll see that if you dispose of a small business, the first 1.8 million is excluded. So only 1.2 million of the gain on the small business is going to be taxable. Simple. So that was the small business dealt with. Now we move on to something about a microlight aircraft. I'll just call it an aircraft to save time. And he owned an aircraft purchased 4 years ago, once again, after capital gains tax was introduced, so the valuation date value is irrelevant here. He purchased it for 200,000. It weighs 350 kgs. That's important. And he sold it for a certain amount. Why is the weight important? Because if you own an aircraft and it weighs less than 450 kgs, in other words, it's very light, it'll be regarded as a personal use asset, and any capital gain or loss of it on it will be disregarded, will be excluded. Okay? So this weighs less than 450 kgs. In other words, it qualifies for the personal use exclusion. So you can just put in here personal use and put a 0 and move on. So that's just a question of learning. You need to know those sort of little exclusion rules going into the exam. Okay. What's the final one? Listed shares. Listed shares are an asset. They are subject to capital gains tax if you dispose of them. He has a portfolio. He received shares when it demutualized prior to 1 October 2001. The value of the shares was then 10 Rand. On 1 October 2001, the shares were valued at 20 Rand. And when it comes to shares, you've got to use the market value at 1 October 2001. So that's 20 Rand, that's what you've got to use. And she sold 1,000 shares. The wife sold 1,000 shares. So what is the proceeds? She sold them for 25 Rand, so that amounts to 25,000 Rand. 1,000 shares sold for 25 Rand each. Their market value at 1 October 2001 was 20 Rand. So in other words, their base cost is 20,000 Rand. So the capital gain is 5,000 Rand. Why are we including the spouse's capital gain? Why are we combining the spouse's capital gain? Because they're married in community of property. You've got to combine them when the couple are married in community of property. So there we have a 5,000 capital gain on the disposal of the shares. The remainder of her share portfolio, which she did not sell, that's important, cost her 50,000 Rand 6 years ago, and these had a value of 110,000 Rand. That's irrelevant for capital gains tax purposes. How do we put it? Remaining shares, include that in the picture. Remaining shares, I would say, not realized. In other words, they're not disposed of. So their value at the end of the year of assessment is irrelevant for capital gains tax purposes. Why? Because they weren't disposed of. So just put a null there. And that gets you to an aggregate capital gain. So we've got the capital gain on the primary residence, on the small business. There's 0 capital gain on the aircraft, 5,000 Rand on the listed shares, and gets you to a total capital gain of 2,609,375. Let me just carry that over to the next page so I can fit it in. Bring down the subtotal, 2,609,375. Now we know that the capital gain, sorry, let's just bring that in, fit that in, sorry about that. There it is. They married in community of property, so the capital gain has to be split 50-50 between the spouses. So they married in, I'm going to abbreviate it, community of property. So 50%, which is 1,304,688, falls into the wife's taxable income calculation. The remaining 50% obviously falls into the husband's taxable income calculation. So there we have the amount. The taxpayer is entitled to an annual exclusion. Don't forget, this is just learning. There's no difficult calculation involved. 30,000 Rand annual exclusion. And in fact, that amount is included in the schedules at the back of your exam. But I'd recommend you know it going into the exam so you don't waste time looking it up. 30,000 Rand annual exclusion. That gets you to a net amount, total capital gain of 1,274,687 Rand. There we have it. And that's not the final step. Remember, the question stated taxable capital gain. That isn't the tax, that's the total capital gain. We want the taxable capital gain. So you simply multiply by 33.3%, multiply this amount by 33.3%, and that'll get you to 424,471. That will be included in the taxpayer's taxable income. And that, very simply, is the calculation of this taxpayer's taxable capital gain.